How much will it cost to hire someone to manage your investments? Are there alternatives to hiring an expensive financial advisor? And can you really turn $10,000 into $20 million? We'll answer those questions and more on the 60-second episode of the DoughRoller Podcast.
Welcome to the DoughRoller Podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Hey everybody, welcome to the 62nd episode of the DoughRoller Podcast. Today we're going to cover some topics that have come in from various listeners who have had just a number of questions. As I've mentioned, I get a ton of emails. Since starting this podcast back in November of last year, the amount of email that I receive and questions and just discussions back and forth has gone up probably tenfold, and I love it. I love getting emails. You know, I get a lot of questions that I don't know the answer to. There's so much involved in personal finance and investing. I don't know how anyone could have all the answers. I know I certainly don't, and I often go off and do research, and oftentimes the questions that you all ask lead to podcast shows, episodes, which is exactly what's happened today. And frankly, I've got now a long list of future episodes that I want to put together based on questions that you all have asked. So it's fantastic. I love getting the email. As always, you can email me at dr@doughroller.net. And so really the entire show today comes from questions that you all have asked, including the money tip of the day. You know, sometimes I call it the money tool of the day, sometimes the money tip of the day. I guess it's all money tip of the day, so to speak. And this one comes from a reader named Marcus. And here's what Marcus wrote me. Perhaps a topic for a future show, financial freedom for a child or grandchild. The following article proposes an interesting idea. Place a one-time gift into a variable annuity held within a trust and just let it sit there for 60-plus years. When your child, grandchild retires, they will be well on their way towards financial freedom. And I think your blog readers, podcast listeners would be interested in your insight into this. Thanks, Marcus. And the question comes from an article that Marcus sent me. It's actually on a website called Merriman, MERRIMAN.com, a website that I was not familiar with. And it's a PDF, and it basically goes through what Marcus just described in the email, and that is you place a one-time gift of $10,000 into a variable annuity. You place that variable annuity inside a trust, and then you let it sit there. And then when your child reaches or grandchild reaches 65 and it's time to retire, they will have accumulated by that time approximately $10 million. And then they'll of course spend some for retirement, but the money will continue to grow. And about 20 years later, it'll be worth $20 million. And so Marcus wanted my view on all of this. And so, well, I'm going to give you my view on all this. I read the article, did some research behind it, and wanted to just cover it, give you a couple of thoughts. First of all, let's quickly talk about variable annuities and trusts. So one, why was this put in a trust? What's the idea behind that? And that's pretty simple. It's a way to keep your child or grandchild from spending the money before they're 65. So you can put it in a trust and you can say, okay, your grandchild, your child, whatever, you're the beneficiary of this trust, but I get to set the terms of it. And by the way, you can't touch the money until you're 65. So that's why it's put into a trust. The trust itself doesn't affect the returns of the investments. It's just a way to keep the money where it should be until, in this case, in the example that Marcus emailed me, until your child or grandchild turns 65. Obviously, a trust and estates attorney could put together a trust very easily. It's not something I do. In fact, I pay a lawyer, in fact, did it recently to rewrite our wills and our trusts. It's just not something I do. But a trust and estates attorney can do that very easily. And then the idea of a variable annuity, and I'm not a variable annuity expert. In fact, I'm working on having a guest on the show about annuities generally, including variable annuities. But why a variable annuity? Why not just stick this in Vanguard Total Market Index Fund or something like that? Well, the idea of the variable annuity is that the money can grow tax deferred, not unlike an after-tax IRA. So you put the $10,000 in, that would be after-tax money, but then it can grow tax deferred until the money is withdrawn, say, in 65 years. That's the idea, as I understand it, as to why, in this example, they're using a variable annuity. But within a variable annuity, you can invest in, say, an S&P 500 index fund, for example. So the investments aren't necessarily significantly different than what you might invest in at Fidelity or Vanguard or what have you. But that's the theory behind why a variable annuity was chosen in this example. The earnings can grow tax deferred. Now, the real issue in this question is: does $10,000 really grow into $10 million by the time your child or grandchild is 65, and then maybe even to $20 million a few years later? Well, that's easy to figure out, right? We can just open up the old Excel spreadsheet, and I've already done that. And of course, the big question is: what's the assumed rate of return? You got to know that, right? And in the article, the assumed rate of return was 11.2%. We'll come back to that. But if we put that in Excel, we use our future value formula, just an equal sign followed by FV. And by the way, if you're listening to this podcast on your way to work, and I know a lot of you are, keep your eyes on the road. Don't worry about the numbers. Don't go into a math coma on me, because it really doesn't matter. But I like to get into the details, so I'm going to walk through this quickly. Equal sign FV and then a paren, 11.2%. You can actually put in 11.2 in the percentage sign if you want, or you can do 0.112, comma. The number of years this investment's going to grow, we'll use 65 since that's what the article used. How much we're going to contribute every period? Well, none. So that'd be 0. And the last number is what the present value is and where we're going to put $10,000 in. And if we run that number through Excel, sure enough, we get to just under $10 million in 65 years. And then the article went on to say if you spent 7% of that a year but let the rest of it grow, in 20 years you could have $20 million. So do the numbers work? Well, the numbers do work, but they only work with all of those assumptions. So is the math correct? Yes, the math is correct. Are the assumptions realistic? In my view, they are not. It is completely unrealistic to make plans assuming that you are going to have an 11.2% return over, frankly, any period of time. The first thing is the stock market simply hasn't returned that much. If we use history, and I know history doesn't always repeat itself, right? But let's start with history. If you look at, say, the S&P 500 or the stocks in the U.S. or even international stocks, they don't return 11.2%. They haven't, at least not over long periods of time. Think 10, 20, 30, 40, 50 years. They don't return that. In short periods of time, obviously they can. Last year, the S&P 500 returned over 30%. So in a 1 or 2 or even 5-year time period, you might hit 11.2% or more. Over the long term, they just haven't done that. Now, again, that doesn't mean they won't do it over the next 65 years, but that's really not the question. The question is, why do we believe they will? Why are we going to use that for planning purposes? So I think 11.2% for that reason alone is unrealistic. The other reason is there are fees for any investing. As you know, we talk about the cost of investing quite a lot and how important it is to understand what the costs of investing are. And I give you my views on that in podcast 28, so you can check it out, DoughRoller.net/podcast 28. That's podcast 28. And I talk about investing costs, how to keep them low, why it matters. In the case of variable annuities, the costs go up. And that's even true if you go with a low-cost provider like Vanguard. As I was working through this show and preparing for it, I thought, well, what does a Vanguard variable annuity cost for sort of an equity index portfolio that might want to track the S&P 500 index fund? As you may know, you can get a Vanguard S&P 500 fund, particularly with the Admiral shares. I want to say it's 5 basis points, I think. Well, the variable annuity actually costs you 47 basis points. It's much more expensive inside of a variable annuity, and that's actually considered an inexpensive variable annuity. There are variable annuities out there that are much, much more expensive than that. So when you're looking at returns, you've always got to be looking at the returns after expenses. And so I don't think 11.2%, in my view, is a realistic assumption. Now, you may be saying, okay, well, that's fine, but I mean, the concept is still worth considering if you wanted to provide, say, for a child or grandchild, investing when they're young and letting it grow. And I absolutely agree, but we shouldn't dismiss the 11.2 assumption. Remember, with 11.2%, after 65 years, it grew into 9.9 million. Let's just take it to 10.2%. What happens if we just we just lose 1%. It's not that much, right? And I'm going to do this in the Excel formula. In fact, I'm going to copy it so that I can keep the original formula. I'm going to move it over to a cell, even while I record this podcast. There it is. So originally it was 9.9 million. I'm going to change the 11.2 down to 10.2, and it drops to almost in half. Well, not quite, 5.5 million, because we lost 1%. That assumption is huge, particularly when, as in this example, we're looking at a 65-year horizon. The small differences can make a huge, small differences in the interest rate can make a huge difference in the final number. Even just going from 11.2% to just 11%, so we're just shaving off 20 basis points, drops the ending value after 65 years by more than $1 million. It goes from 9.9 to 8.8. Just by losing 0.2% from 11.2 to 11. So that's a big assumption. I think, in this paper, they used 11.2%. I just don't think it's justified. Again, the markets don't return that much. You've got to factor in expenses. And with variable annuities, even low-cost variable annuities, expenses can be a big deal. The other thing you need to think about is inflation. If inflation is going to really devalue the purchasing power of these investments over a 65-year period. In the article, they talk about withdrawing 7%, which would be $700,000. 7% of 10 million would be $700,000. But they point out, this was written a few years ago, but in current day purchasing power, that would only be $135,000. So you can imagine 65 years from now, you may take out $700,000, a lot of money, but it's only going to buy what you could buy today at $135,000. Now again, $135,000 is a lot of money as well, but it really shows you how over long periods of time, even low rates of inflation can really eat away at the purchasing power of your investments. Just one of many reasons why I think investments in equities is so important over bonds and other fixed income investments when you're investing for the long term. So in response to the email from Marcus, I really like the concept, putting aside whether you'd use a variable annuity or not. I like the idea of investing for children and grandchildren. I love the idea of helping out your young adult children, perhaps in opening up a Roth IRA and helping them fund it, assuming they have enough earned income where they can. I think it's a great idea. And I think the idea in this article is a great idea. You just have to be realistic with it. I think assuming 11.2% return is just not realistic. But again, in my example that I changed it to 10%, you'd end up with 5.5 million. Not bad. Let's say you only got an 8% return. Well, in 65 years, you'd end up with $1.5 million from a $10,000 investment. Again, that's without adjusting for inflation, but still could be a great way to save for a child or grandchild's future. So in concept, I like the idea. Just need to be realistic about what it's going to accomplish. That's my view. You have a different one, love to hear it. dr@DoughRoller.net. Okay, now on to the main topic. And this really is, as I mentioned today, all of the topics here are from readers. And this one, I've gotten a number of emails. I'm going to read two of them. I'm sure I'm missing someone. And if you've emailed me about this topic and I don't mention you, I apologize. I've got two emails, and it has to do with this. Should you invest on your own, or should you hire a fee-only financial advisor to invest for you? So let me read you the emails. The first one comes from Deborah. She writes, I have been reading your emails and enjoying what I have read so far. As my husband quickly approaches retirement, I do have one question. How much money should a financial planner charge, per hour or a percent of your portfolio? My husband and I are not accountants, but have to face this money dilemma out of necessity. Thanks for your info. Deborah. And by the way, when she refers to my emails, she's referring to the newsletter that I send out every Saturday. If you haven't subscribed, you can do that at DoughRoller.net/newsletter, one email a week. And I try to chock it full of helpful links to helpful information, both on my blog from DoughRoller, but also from other sites that I write for. I write for Forbes and Huffington Post and U.S. News, as well as articles written by other folks that I think are just helpful to you in managing your money. So that was Deborah's email. Then I got one from Timmy. Timmy wrote, if you were a 20, and I should say the email is much longer than this. I'm sort of boiling it down to the question. If you were a 28-year-old in my shoes, would you go to a fee-only planner for advice or just educate yourself and invest on your own? So these are kind of similar questions. They're very important. I suspect a lot of you are kind of wrestling with this, whether you're just starting out and trying to figure out, should I do this on my own? Or maybe you're closer to retirement. You've got this big 401k and you're going to be rolling it over into an IRA, and it's scary. It's scary to take $500,000, $1 million. Maybe you've got more, and putting it into an IRA. There's a lot at stake, and we shouldn't underestimate the importance of these decisions. And so I want to look at this question in a couple of different ways today. I've broken it down really into three different sort of sub-questions, if you will, that we're going to walk through. But the first thing I want to do is say this. I'm kind of working forward on the assumption that you're considering a financial advisor to help you invest your money, whether it's for retirement, invest in an IRA, taxable accounts, whatever. You're looking for someone to help you invest your money. Now, there are other reasons, of course, to reach out to financial planners and certified financial planners and other things like that. I mean, you just may want help with budgeting, and you want help just with some sort of higher level plan for your money, and understand how much insurance you should need. And you really want someone just to put a financial plan together for you, not necessarily managing your money. For that kind of thing, you generally just pay an hourly fee. Some companies will have sort of a flat fee, and for whatever, some amount of money, you'll get a sort of detailed financial plan. They meet with you a couple of times, put together the plan, and it's yours, and there you go. Good luck and Godspeed. And that's fine. We've actually, long ago, my wife and I had someone put that together for us. Interestingly, I didn't find it as helpful as I thought I would, but maybe that's just where we were at that point in time in our finances. But that's different. If that's the kind of thing you're looking for, I think you would look for that on either a per hour basis or maybe a flat fee. But what about managing your investments? Now, when I first started blogging and I started talking about investing, I just assumed everyone should be managing their own investments. I mean, that's what I do. It saves you a lot of money in the fees. Why wouldn't everyone do this? It's not that complicated to my mind. And what I've learned over 7 years of blogging about personal finance and investing is that it's kind of an obvious thing, I suppose. We're all different. We all have different fears. We have different skill sets. We have different education and different willingness to learn. And we're different. And where some folks want to invest on their own, some other folks may be scared to death. Just like I would be scared to death to renovate our kitchen, scared to death. And some of you listening out there say, "Rob, you're crazy. It's so easy. I renovated my own kitchen. It was no big deal. Saved a lot of money." Well, it may not be a big deal for you. For me, it would probably be a disaster. So we're all different, and I get that. And so some folks want more help. Some folks want to do it on their own, like I do. So with that in mind, let's kind of walk through three questions. So let's start with this. Should you invest on your own or hire a financial advisor? And I'll say right at the outset, I really don't like that question because it suggests that those are the only two options. You either invest on your own, you're by yourself, good luck, or you hire some expensive financial advisor and turn it all over to them. There are other options, and that's the first thing I want to say, and we will get to those options in a minute. But for this first question, I'm going to stick with the basics. Do you do it on your own, or do you hire someone or get some help in some way? And I think as you think through this question, I kind of put it into sort of four things to think about. The first is, and why do people want to hire a financial advisor? Why do they think about it? The first is lack of information. They just don't understand investing. They don't understand asset allocation and which mutual funds to invest in. Could they go learn it on their own? Sure. I think probably everyone listening to this podcast could. But some folks have more interest in doing that than others. Some have more confidence in themselves to learn all of this information than others. And so I think that's the first reason folks tend to want help is just a lack of information and a way to tap an expert for this. The second reason, I think, is just lack of time. You may say, yeah, I know I could learn it on my own. I'm confident that I could, but I'm just busy. And I've got a business I'm running. I'm a lawyer. I'm a doctor. I'm a teacher. I've got family, whatever. I just don't want to spend the time to do it. Now, it'd be interesting how many people listening to this podcast fall into that category, given that you are listening to a podcast about personal finance and investing. But I'm sure some of you do. I know I've heard that from many people. It's not just a lack of information or a fear that you can't learn what you need to know. It's just, I don't want to spend my time doing it. So that's the second reason. The third reason is really the third and fourth, they both relate to fears. The first one is a fear of missing out, a fear of I could just do better with my investments if I'm afraid I'm missing something, some information about asset allocation or which mutual fund I should pick. I've got this fear that I don't know it all, and there's this secret out there. The financial advisors have this information that if I just had it, I could just get a little bit more out of my money. The fear of missing out. I think we have this a lot of times if we have a conservative portfolio. And like last year, the S&P 500 is up 30%. Like, oh, I'm missing out. I have 50% bonds and 50% stocks. That's what I decided on. I feel like I'm missing out on these returns. Well, the same thing can happen just as you plan your investments overall. What am I missing? And there's this fear that develops in some of us. I know I've had it, particularly when I was first starting to invest. And then the fourth thing is the fear of making a mistake. It's similar to missing out, but it's different. It's a fear that I'm going to make some decisions and they're going to turn out to be the wrong decisions. I'm going to pick my asset allocation plan and I'm going to end up having put too much in stocks or not enough in stocks. I'm going to pick mutual funds and it's going to turn out to be the wrong mutual funds for me. Or, I'm going to make this mistake and there's so much riding on how I handle my investments. It could really affect my retirement, my family's retirement, our peace of mind. I'm afraid I'm going to make a mistake. I think when we break it down, this decision of investing on our own versus hiring a financial advisor, one or more of those four things come into play. Lack of information, lack of time, fear of missing out, fear of making a mistake. And I think as you think through what's best for you, it's important to pinpoint why you think you should hire a financial advisor, or for that matter, why you're comfortable going out on your own. And I think you'll end up in one or more of these buckets. And the reason I mention that is a couple of things. One, when we invest in a 401k or 403b, these are workplace retirement accounts. We invest on our own. Yes, there's a plan administrator. My 401k is administered by Fidelity. Can I get on the phone and call Fidelity? Yes, I can. And will they give me some general advice? Sure. But at the end of the day, it's me sitting in front of that computer screen looking at those 30 different investment options that Fidelity gives me inside my 401k, having to pick one or more of them. What percentage do you want in each? And you're ready to click that, submit button, and you're like, is this right? And you just click it and hope it all works out. The point is, though, you are investing on your own more or less in a 401k and 403b, so you may have a little more comfort doing this than you're giving yourself credit for. The second thing I would consider is, particularly when you're starting out, you start out slow, right? When you're just entering the workforce and you're just investing in a 401k, or maybe you're starting to invest in an IRA or taxable account, you probably ain't moving a couple $1 million into your investments. You're probably investing $100 a month, $500 a month, $1,000 a month. That's how I started. My first 401k contributions, I don't remember exactly what they were. Very small though. And I do remember my first taxable contribution, Legg Mason Value Trust, managed by Bill Miller. And I was investing $100 a month. And it gave me a great opportunity, I'll be honest with you, to make mistakes. And I made lots of mistakes, particularly when not with the Legg Mason, but when I started investing in funds with a lot of fees. I made mistakes, but I was making mistakes with relatively small dollar amounts. It's one thing to make a mistake investing $100 a month. It's another thing to make a mistake with $1 million. And so as you're going through this journey, and that's really what it is, if you're just starting out, you may take some confidence that you're not investing a lot of money to begin with, and you can learn as you go. Now, that being said, if you don't have time, you don't want to spend your time worrying about your investments, you don't want to spend your time getting the information you need, a financial advisor may be the best option for you. You can it's like I would hire a contractor to renovate my home. Investing for retirement is every bit as important, if not more important. Again, I think the information is fairly easy to grasp, and it doesn't take a lot of time. That's kind of one of my goals with this podcast and my blog, is to at least walk through how I do it. But again, I recognize that may not be right for everyone. If it's fear that's driving your decision, then again, if you start slow, maybe you can deal with your fear that way. Then again, you may be closer to retirement and rolling over a 401k. You may be rolling over $1 million or more. And so you're not starting slow. You're worried about how you deal with this money and how you invest it. And so some kind of help is in order for you. So we're going to get to that. I'm going to give you some options. So there's more options than just going out and hiring a financial advisor. We'll get to that. But those are the factors I walk through. Think about why you're what's important to you, why you may want a financial advisor, what the risks would be if you do it on your own. Again, I think it's a big difference if you're just starting out and you're investing just a little bit of money each month versus you're close to retirement, you're rolling over a lot of money that you really need to make sure it's handled correctly. You don't have the time to make mistakes. So those are the factors that I consider what I think drives this decision. I don't think there's one right answer for everybody. And so that brings me to question 2. If you are considering a financial advisor, how much do fee-only planners, fee-only advisors cost? Well, rule of thumb, they cost 1% of your invested assets. So if you roll over a 401k, for example, and you're going to have a financial advisor manage it for you, you're going to roll it over into an IRA, but they're going to manage it for you, and you've got $1 million. They're going to charge you, typically, the rule of thumb is 1% of that amount. And if your investments go up between now and next year, that 1%, of course, will result in higher fees. If they go down, that'll result in lower fees. But that's the rule of thumb, 1% of invested assets. So something to keep in mind here, their fees are not directly based on performance. They get paid whether you lose money or make money. Now, over the long term, you hope you're making money, and you should be. And of course, as you make more money and have more money in your account, the fees grow. But that's one thing to keep in mind. The fees are not based on, or at least not directly, on performance. They're getting, if it's 1%, they're getting 1% year in and year out on whatever you have invested with them. That's the rule of thumb. Now, let's get to some reality here. Some advisors will cost you more. Some will cost you less. I've seen advisors that cost a lot more than 1%, sometimes 2%, which I think is just crazy. But they're out there, and somehow they get business. And but there are others that cost less. Now, many charge based on the size of your portfolio. So the more you have invested with them, the fees tend to go down. So that's something to consider and think about as you're looking at fee-only advisors and what they will charge. Now, we had Rick Ferry on the show, and I'm going to actually look up the podcast number because I think it's number 3. Yes, he was in podcast 3, so you can find that DoughRoller.net podcast 3, podcast followed by the number 3. And he founded Portfolio Solutions, and they charge a fee of 37 basis points. That's 0.37%. So that is, as advisors go, very inexpensive. Now, you do need $500,000 to open up an account with Portfolio Solutions. The other thing is you really only get the 37 basis points once you have $1 million invested with Rick's company, because they do have minimums. So if you actually started with $500,000, your percentage fee would actually be twice that. But as you get to $1 million, it ends up being 37 basis points. And then it actually gets even lower if you go over, I think, $3 million. But I give Portfolio Solutions, I use them as an example, not to say that that's right for you. I'm not a certified financial planner. I'm not a registered investment advisor. I can't tell you what's right for you. But I use that as an example because they charge less than 1%. So you can find fee-only advisors that charge less than 1%, but you often need a fairly sizable amount of investable assets to get started with folks like that. That's not at all uncommon. Again, rule of thumb, 1%. They can be a lot higher or, in Rick's case, lower. Costs do oftentimes depend on how much you have to invest. Usually, the more you have to invest, the lower the costs. Okay, so we've talked about whether or not you should invest on your own or hire a financial advisor, some things to think about. We've talked about what is sort of typical for fees if you are going to hire an advisor. Now, the third and final thing is alternatives. Before you make decisions, I think it's important to know what your options are. And I want to mention 2 alternatives to simply going out and hiring a financial advisor to manage your investments. The first is there are a number of online investing options, a number of online tools that can make investing easier. They actually call them robo-advisors. If you Google that term, you'll see a lot of news articles about these robo-advisors. I don't really like that term, but basically these are companies that have taken technology and used technology as a way to help people invest their money. We've talked about a number of them on the podcast. One of them is Betterment. Remember, Betterment was a sponsor of the 31-Day Money Challenge, and they make investing easier by giving you online tools where you simply pick the amount you want in stocks, the amount you want in bonds, and basically Betterment does the rest and gives you a lot of tools to monitor your investments and how they're performing. We've talked about Motif Investing. I interviewed Tuan Ghosh of Motif Investing in podcast 54. But that's another example of a company that's trying to make investing easier. And in the case of Motif Investing, I think bring in a social component to it. But again, if you want more there, you can listen to podcast 54. But that's another example. I've talked about Personal Capital. Now, I use Personal Capital, their online tool. I think it's fantastic. And that's a free tool, but they also offer advisory services. I mean, that's really what they are selling. So while you can use the tool for free, they also offer advisory services to those that want to use it. So that's another example. There are others. There's Wealthfront. There's Future Advisor. There's Rebalance IRA. And here's the deal with these. So usually the cost, first of all, there's a cost for all of these. Now, like I mentioned, Personal Capital, there's no cost to use its tool, but if you want to use its advisory services, there's a cost. And the costs that these various companies charge are over and above the expense ratios of the investments that they would put you into. And so you're paying for help, basically. You're paying for either to make investing easier, which is, I think, in large part what Betterment does, or in some cases, you're actually paying for specific customized advice, very specific to your needs. And I think that's more probably what Personal Capital offers. And what happens, though, is the more personalized the advice becomes, usually the more expensive it is. And that kind of makes sense because then individuals get involved, financial advisors working with you one-on-one versus simply using an online tool to help you invest, like Betterment. But the thing I like about that range of offerings is some folks are going to want more help and some folks not as much. Some folks might say, I don't really want to do this on my own, but I don't need someone on the phone with me every day. If I can just get the help that, say, a Betterment offers or that a Motif Investing offers, that's enough. Terrific. It's there for you. You can use it if it works for you. Others may say, no, I want a little more hand-holding, but I don't want to go all the way to a 1 or 2% fee-only financial advisor, so maybe some of these other options will work. Now, what I'm going to do going forward, I mentioned that I've interviewed someone from Motif Investing, Tuan Ghosh, in podcast 54, DoughRoller.net/podcast 54. I'm going to actually start reaching out to all of these folks and interviewing them in upcoming podcasts and asking them, what services do you provide? How much does it cost? How does it help the investor? Who do you think this is for? Who do you think your tool maybe is not for? And so that's one of the things I'm going to do in the upcoming weeks and months. And then I think over time I'm going to pull together something on the blog that I'll mention. I'll give you links to it when I get it done. But that kind of gives you sort of a spreadsheet, if you will, of all of these different services and how much they cost and what they offer as a way to give you some alternatives. Now, the last alternative I'll mention, and this one I think, this is my favorite, okay? And that is call the mutual fund companies. The folks at Vanguard or at Fidelity will absolutely help you. If you're going to roll over an IRA, particularly if it's got a lot of money in it, they will help you decide what's best for you in terms of your investments. They will walk you through it. In fact, when a family member was doing just that very thing, and they wanted my advice, and I get very skittish when it comes to giving a specific individual specific advice to their specific needs. Because I'm not a registered investment advisor, I'm not a certified financial planner, and although I would feel very comfortable making those decisions for me, I don't want to make those decisions for other people, even a close family member. So what I said was, hey, Vanguard will help you. So they wanted me on the phone call, so Vanguard was fine with that. So we got on the phone, and Vanguard walked them through the considerations and what they recommend and what's good for they were getting near retirement. So what's a good asset allocation for retirement? And if you go with that, which funds at Vanguard would you invest in? They walked them through it, no charge. And I'm confident other mutual fund companies do the same thing. My experiences with Vanguard. So when we talk about hiring a financial advisor versus doing it on your own, recognize this. No matter what you choose, you never have to literally do it on your own. Whether you get help from a Vanguard or Fidelity or some other mutual fund company, whether you use some of the other alternatives I mentioned, like a Betterment or a Personal Capital or Motif Investing, or whether you go ahead and hire a financial advisor like Rick Ferry or someone else. There is different levels of service, different levels of help, of course, different costs that are available to you. And I think you really ought to consider all of them before you make a decision that's best for you and your family. So that's how I think through financial advisors. I do think cost, as you know, is critical. So no matter what you do, you got to consider the investing costs. It's funny, I didn't really plan it this way, but the money tip of the day talked about turning $10,000 into 10 or 20 million. And we talked about how even going from 11.2% to 11% made a difference over 65 years. Now, I know that's a long time, probably much longer than any of us will invest, but trust me, it makes a big difference over 30 or 40 years as well. Costs matter. So as you make the decision that's best for you and your family, really make sure you understand the costs and what the individual or the company is offering you for those costs. That would be my suggestion. Again, there's no one right answer. And the other thing is you may not keep with the same approach throughout your investing career. You might start with a financial advisor and get to the point where you're comfortable and want to do it on your own. Or you may do it on your own, but then as your balances grow and grow and grow, you get a little less comfortable handling it on your own, and you go out and get help. Right? It's not like you have to make this decision once and stick to it for the rest of your life. The other thing is you may decide to get help with some of your investments, but not all of them. I've talked to people that have done that as well. So there's a lot of flexibility here, a lot of options, a lot of good, sound, reasonable approaches. The key is to do your homework and find out what works best for you. Well, that brings our show to a close. That means it's music time. There we go. If you want to get the show notes to this episode, you know what to do. Just go to DoughRoller.net/podcast 62. That's podcast 62. As always, love to get your emails. Shoot me an email, dr@DoughRoller.net. I read them all. I answer them all. And if you haven't signed up for the newsletter, you know how to do it. DoughRoller.net/newsletter. We send it out every Saturday, chocked full of links to information that can help you make the most of your money. And finally, if you haven't done it yet, consider leaving an honest rating and review of the podcast, of the show, in iTunes. Just go to DoughRoller.net/iTunes. It will redirect you to the iTunes page where the DoughRoller Money Podcast resides. Hey, until next time, remember, the best thing money can buy is financial freedom.